Hello and welcome everyone. We are doing a little bit of an AI analysis for Gray Capital's latest multifamily investment opportunity open for accredited investors, flats at Stones Crossing. Now, I've never done this analyzer before, so we are using the Passive Pockets deal analyzer. Pull it up here. The Dewey Instant Due Diligence Advisor. I believe this is something that the Family Office Club folks put together. That's what it said on Passive Pockets. I've never used it before, but we have a new deal here at Great Capital, flats at Stones Crossing. It's located in the Indianapolis market, or MSA. It's suburban Indianapolis, technically in Greenwood, Indiana. But first, my name is Spencer Gray, President and CEO of Gray Capital, and we specialize in acquiring and managing high-quality multifamily properties in the Midwest. And I love deals. I love doing good deals, and I like stress testing our deals. And so again, this is live. Never done this before. I don't know what it's going to say, and so I've just uploaded. I'm dropping the deck in, and so like if you want to do due diligence on Great Capital and the deal, you can watch. I recommend doing your own due diligence, but we're going to just do some on ourselves to see what is going to come out. I'm just going to prompt it. Help me conduct due diligence for this deal. Let's see what happens. As it's coming back. Okay. Full due diligence and analysis. And by the way, if you want to check out the deck that I'm having to analyze, you can go over to graycapitalllc.com and get the deck yourself. Take a look at it. We'll probably ask you for an email address or something like that. You do have to be accredited to invest, but you don't have to be accredited to download it. So, and we take a lot of pride in these decks we put together. Try to be really transparent. We keep asking ourselves, what else can we add? What do our investors want to see? What do prospective investors want to see? So, I mean, we put the full unabridged underwriting model in there, tons of sensitivity analysis, break-even analysis. We go over risks in the deal, all comps, market studies, risk profile, all of that stuff. So go over to graycapitalllc.com and check it out. You can also learn a little bit about kind of Great Capital, what we do, our track record, all of that. That's all very important. Okay, so let's get back to the DD. And again, this is just live. We're just looking at it. I've never run this before. I've never used this kind of app inside of ChatGPT. Okay. So it's an opportunity to invest in a newly built 292-unit Class A multifamily property called Flats at Stones Crossing, located in Greenwood, Indiana, growing suburb of Indianapolis. The sponsor is Great Capital, a seasoned Midwest-focused multifamily syndicator with over $2 billion in transaction experience so far. They're right, and this is also not just a kind of a stress test of our deal and the deck, but also we're learning more about this model. I know the deal pretty well, so we'll see if it's BSing anything or not. Investment is structured through a special purpose vehicle, SPV LLC, managed by Great Capital. The deal appears to be a Reg D private placement, likely 506C, as it's open to accredited investors only. All correct. Fees, investment fees summary. Okay. Acquisition fee 1.5%, asset management 2%, property management 3%, loan guarantee 1%. Investors receive an 8% preferred return before an 80/20 LPGP profit split kicks in. All correct. Reminder, always involve real estate veterans with 10 to 20 years of success in this niche when evaluating such deals. Also, you must read every word of the offering material yourself in addition to using AI. Good advice. Good advice. Well, luckily for us, I have over 10 years of experience, specifically in multifamily, coming up to 19 years of real estate investing experience. But I've been investing in multifamily since 2015, and our folks in our team have been in the multifamily industry, some for getting close to 30 years. So a lot of experience on the Gray Capital team. But that's one of those things that you can only do so much. Like if I was, 5 years ago when I was in the business, I wouldn't have had 10 years of experience. Now we did some incredible deals 5 years ago. So, those types of metrics of like need to have been in the business for X amount of years, needs to be Y years old, or when we see in like the fund world of like, we don't invest in first time funds, or even like, second time funds. We're not sure. You need to be in like your third or fourth fund. How one gets to fund 1 to fund 4 with no one investing in fund 1, it's a chicken and the egg, but people make it work. We did our first fund. That was hard to raise for. We did it, and we've got a second fund that is for institutions, but that's for a different video. Okay, key deal metrics: IRR target 16.23, minimum investment 100,000, preferred return 8%, equity split 80/20. We've talked about that. Equity offering likely Reg D 506C, true. Accredited investors only, true. Experience: great capital has completed over 25 multifamily deals with no investor capital loss, over $2 billion transacted on 10,000 units owned. We don't currently own 10,000 units, but we have have owned well over 10,000 units and transacted on $2 billion. We manage, do the actual property management for around 2,300 units, and we own around 5,000. I did a lot of co-GP deals before I founded Gray Residential, a property management company, and started managing all of those deals ourselves and being the lead sponsor. So that's a little bit of history. Risk dial, institutional quality score. Okay, so I'm colorblind. I think they're giving us a color grade because I see difference in colors, and I can't really tell the difference. Is it green or is it orange? Asset quality. Anyway, let's see what it says. Class A 2024 construction. I think that's good. Location: Greenwood, Indiana, growing suburb. I think that's great. Sponsor experience. I think they're giving us a green there. Market volatility. Maybe that's an orange. Leverage 70% orange. So overall risk level, moderate to low. So they're giving Indianapolis, so this is where I guess we're going to come into the critique of the model. Indianapolis, market volatility, one of the least volatile markets in the nation. So if Indianapolis is not getting a green, I don't know who gets a green. Again, this is the same type of people who say that like Phoenix is a very stable market or a great place to invest. It can be, but it's not. It's very volatile. Greenwood is maybe the high rate of growth in Greenwood leads to a little bit of market volatility. I don't know. Leverage 70%. Yeah, fine. Give it an orange. I mean, it's not 40%, 50% leveraged. We're using some moderate leverage. Using it wise. It's a good tool. So institutional feel, yes. Professional sponsor, fixed debt, conservative leverage. Okay, all right. So far, the step 2, I guess, is it's trying to determine if we're in kind of the institutional zone or if we're in kind of the fringes a little bit. And so far, it's got an institutional feel. The vibes feel institutional. Good. Okay. Let's first principles breakdown. Okay. The person who put this together, they were specific how they want to look at deals. I like it, though. I like it. First principles, core value creation mechanism, buy newly delivered core plus asset with in-place cash flow, okay, enhance NOI through amenity upgrades, phasing out concessions, applying AI-based revenue management. All that is true. Revenue, physics, the physics of revenue. Monthly rents collected from tenants in a stable suburban market, short-term rental, and corporate lease options could increase per unit yield. Yes. Primary cost drivers, property management, taxes, insurance, minor amenity capex, around $200K, and marketing, leasing expenses. Okay. Minimum viable execution model, maintain 90 to 95% occupancy at projected rents while keeping costs in check and optimizing NOI through tech and Gray Residential platform. Okay. Step 4, falsifiability test. Okay, I guess we're stress testing. It's like, oh, I always get nervous during the stress test. Luckily, we've already stress tested it. But if occupancy falls below 85% for longer than 12 months, NOI would suffer, impacting cash on cash and IRR targets. True. Yes, it would. If occupancy fell below for 85% for over a year, that would impact returns. definitely. A rise in property tax assessment or insurance rates in Indiana could erode net cash flows. Very true. But this property was recently assessed, and there's new legislation in Indiana, SB1, that will lower our assessed value over the next 5 years. We've already had a full tax assessment by our tax attorney, so I feel pretty comfortable with that. Local rent growth failing to meet projections could invalidate assumptions on rent roll stabilization. Definitely true. If we aren't able to hit those rent growth metrics, we're projecting rents lower than what we're seeing at our own properties in the same market, and in line with what the market has been doing during a period of high supply. We're coming off a period of high supply to a period of low supply. Specifically, the market has been absorbing about 100 to 250 units a quarter, like the sub-market, the small little area in Greenwood. There's only 200 units that will be delivered over the next 3 years. So I feel relatively confident with those dynamics, combined with the significant population growth and high incomes, and the submarket that the property is in. It's in the Center Grove School District, which really only has like 2 other competing apartment communities. So if you want to live in an apartment, you can't afford to buy a home, which is a lot of people, and you want to live in a somewhat newer apartment, you only have 3 options in this one of the best school districts in the state. So anyway, I mean, I'm obviously pitching the deal and why we're confident that we think that we are under, we are below our rent growth projections. We believe are below what will actually occur. But certainly if we don't hit those, like if a recession happens and the economy falls out, we're not going to be able to raise rents. Not nearly as we will eventually, but not quickly in the near term. Rent growth failing new projection. Number 4, if short-term rental use is restricted by local laws or underperforms, upside could diminish. True, it's not a large component. It's underwritten for like 3 units, and then put the money to ramp up to 7. It adds some revenue, but it's not overly material to the return profile. Sponsor delays in executing amenity upgrades or failing to remove concessions would reduce projected returns. Possibly. I mean, I think the amenities are really going to help. The deal it's not the linchpin on the deal. It's not like we're renovating the units to get a $200 premium, and the deal only works if we get that premium. Frankly, we didn't bake in any additional rent growth because of the amenities. We think it's going to be easier to lease. It's going to help out with marketing. It's just going to be a better property. It's going to look good. Number 5, sponsored. Oh yeah, I already read that. Sponsored delays. The concessions. Sure. Now we actually just did some secret shops. We sent one of our team members out to all of the nearby communities in the market and did a tour like they were a resident. And there were concessions in the market. And in our underwriting model, we still have concessions in the first year, but we're phasing those out over like 18 months. From recent surveys, again, we just did these tours yesterday, the concessions have come off the comps. So we're like in real time, we're assessing, are we going to have any concessions once we take ownership? So I'm not as worried about number 5, but certainly, or like, let's say we've got a pretty good sense of, again, there's only 200 units that we know of that are going to be going into like the surrounding area over the next 3 years. Let's say there's another community that is just absolutely flying under the radar that we don't know about. What if there's like 1,000 additional units? Which, I mean, no one is developing that much right now. But like, let's say that there were significantly more units in the market, which the market needs 1,000 more units. But they're not building. But if they did, those units in lease up would most likely offer concessions, and it would probably require us to also offer concessions. Now, if those properties were built, which again, they're not being built today, but let's say they started building tomorrow, it's going to take them, a year to 2 years to build it, to deliver it. It's most likely going to be delivered at a much higher price. Going to be asking significantly higher rents. It'll be the newest thing in the market, so certainly there'll be some concessions. But yeah, I don't see that happening just because people are not building right now anywhere because the equity isn't there. Interest rates are high. Bayesian confidence weighting. 16.23 IRR over 5 years. Confidence, 75%. Okay. 70% confidence. Reasonable underwriting. Rationale. Reasonable underwriting, but dependent on execution and market rent growth. Okay. See, the execution I'm not worried about because I'm going to be executing. Rent growth, I'm not in control of that, but I'm confident. And we have a data scientist on the team right now. We do a lot of research into the data and the metrics. 2x equity multiple, 75% confidence. Conservative leverage and NOI growth plan support it. Good. Great capital has never lost investor capital. I mean, I know that. They're 90% confident. Verified track record from full cycle deals. 7% average cash on cash return. This is the least confident. They're only 65% confident, dependent on lease up pace, rent escalations, and expense control. I'll give them that. Of anything you could be the least confidence in, it would be, I guess, the cash on cash returns. Although I think the IRR also, any of the return metrics, I guess I would be more confident on hitting like the 16 plus IRR than the cash on cash can be a little bit more volatile. Like let's say something happens. What I'm saying is I can imagine a number of scenarios of where we hit or exceed a 16 and a quarter IRR, but possibly fall short on the 7% average cash on cash. I'm not saying that I think that we'll fall short. I'm just saying that I can't imagine a scenario where we're crushing higher than 7% cash on cash and not exceeding a 16.23. But you can, maybe fall short on the cash flow, but then you still sell it for a high price, get that 16 over the 5. Definitely possible. Okay, step 7, signal to noise ratio. Score 8.5 out of 10. I don't know. I'm not sure if that's good or bad. The deck is data rich with real metrics, past case studies, GP co-investment details, and market comps, limited fluff, clear focus on fundamentals. Would be a 9 plus if it included a full T12 and rent roll. It's in the data room. Go check it out. I'm not gonna. So the deck is already. The deck's over 45 pages, guys. The deck's over 45 pages. It's already too long. We want to be able to print it. I want to print it and make it look good. But if we print it, we can't have nice paper, and have the rent roll. So the rent roll, that's something that's going to stay digital. I'm sorry, we're not printing out a rent roll. And I also I don't know how big I am on. So this is the deck. I mean, it's a long. Oh my gosh. You're right. We do not have a full rent roll on this deck. We have all of our full underwriting. We also just ask us for it. Like the model, we don't put in the data room because we have a lot of people that come in the data room, but we always will share that if someone asks for it every single time. That's just how we roll. Okay. Step 8, entropy of execution. I don't know what this means, but we only got a 5 out of 10. The execution plan is relatively simple. We're going to manage a stabilized asset, apply in-house property and asset management, phase out concessions, enhance amenities, and adjust pricing via tech. Risk is moderate due to operational components like short-term rental rollout and AI-based pricing. The AI-based pricing, that's our dynamic pricing, revenue management, whatever you want to call it. We've seen a lot of success with it. I don't know where the risk comes in from that. I don't know if 5 out of 10 is, I don't know if 1 is good. Usually 10 is good. I'd like to get a higher score, but I don't know what we could do better. I like how on the signal to noise, how it tells us what we could do to be a 9 plus. I might ask you that when we're all done here. Okay. Step 9, top 7, due diligence questions to ask. What is the current rent roll versus the pro forma rents? That's a great question. I can pull up our model. It's about a $30 difference between rents on the current T12 and the pro forma. You have to keep in mind when you look at the T12 for this property, when you take a look at it, the property was in lease up last year. So we've had a couple people look at it and say, well, your T12 cap rate looks low. You're like a mid-4 cap rate on your T12. It's like, well, the property was only 50% occupied 12 months ago and then 11 months ago. So it's a T12. Doing a cap rate on T12 is really inappropriate because you need to do it on a stabilized trailing financial statement. So if you look at it on a T3, we're in like the mid, basically 5.3, getting up to 5.5. When we close, we'll be inching up potentially 5.75 to a 6% cap rate as they are actively increasing rents and they've been surging in occupancy at the property itself. But yes, we can provide trailing T12 and financial and occupancy history. We have the occupancy history in the deck. We're almost certain if we usually add it, but of course we'll provide that. What's the track record of Gray's AI-based revenue management in comparable assets? We can send that over. It's been great. It's been finding opportunities where we've missed. It's a little bit of work to train the teams on how to use it, but it's a great tool. You don't set it and forget it. It's an active thing that you have to use. And we're working on a case study right now. What comps support the 7% average cash on cash projection? That's a strange question. I would say a better way to ask that question would be what comps support your rent growth projections, and that we can definitely, let's talk about that. Okay. So this is our chart of comparable properties in the submarket. These are real comps. We've got some properties that are not as nice. We got some properties that are built in the same year, just as nice, and some ones that are really nice. Basically the same thing. The only real outlier, I would say, just being honest, is the Redwood, Greenwood. It's that last one that's really high. It's not BTR, but they're like quadplexes, duplexes. It's more of a BTR type community, so the floor plans are a little bit larger. So average rent per unit at flats is right around $1,600. And there's 4 properties that are all similar vintage, same submarket, except flats is in a little bit better school district than some of these, like Hanger, Arlington Farms, Maverick. They're not in Center Grove School District. So here are the comps. I mean, it's almost a $400 swing between Redwood and flats. Again, take that out. It's a $220 swing on average between flats, Stones Crossing, and Maverick Modern Apartments, which I think is our best comp. It's a hair newer, and they have a few more garages than we do. But then take that out, then we're 75 to 100 above below Timbers, the Hanger, or Arlington Farms, and then we're right in line with Verge as well. But great questions. In Arlo on the 1 bedrooms, these are the 2-bedroom rents, 3-bedroom rents, and then if you want to look at a price per square foot. Oh yeah, there's the Madison. Where's the Madison? Oh yeah, they have smaller units. Yeah, smaller units here at the Madison. You see over here, way up here, high and to the right. Anyway. Okay, what's next? Are short-term rentals permitted in Greenwood, Indiana, under current zoning? Yes. What are assumed exit cap rates versus current market cap rates? We're using a 5.5% cap rate. A-class deals in Indianapolis are trading in the 5 cap range. There's a deal earlier this year that traded for a mid-4 cap. I know that sounds crazy because people want 6 caps and 7 caps right now. Indianapolis has been performing so well. Consistent rent growth. The supply is stable, that the floor on the pricing has been relatively high. There is an active bid on Indianapolis. I mean, there are more groups that are looking at Indianapolis than there have ever been before. All right. We did the exit cap rate. Is the 200K in amenity upgrades budgeted as hard cost or contingency? It's a hard cost. It's a hard cost. We have contingency also. We've got a couple $100,000 in contingency. Final note. This appears to be a professionally structured, moderately conservative core plus deal led by a seasoned sponsor in a strong Midwest growth submarket. However, the investment still carries risk, as all things do in life. You must always validate all claims, original docs, get in-person references from prior investors, confirm zoning and legal assumptions, involve experienced advisors in the due diligence process. Always a good idea. Awesome. So it'll let you do more. Okay. Cool. Well, I think that this was interesting. I think it would be helpful, especially if you just wanted the down and dirty. What's the deal? Is it a deal? What's the story? This would be a good tool. I mean, I've had what this is nice is, and you can do this yourself. You can do your own little GPT. You can like stack prompts and have it save prompts, but it's nice because it has all that done for you. If you don't want to have to do that work, you can just drop it in, drop a deck in, and start asking questions. And maybe we do that too. But let's ask it a couple specific questions. And so I would recommend it. Now, I think you have to be a member of Passive Pockets to get this. So anything that costs money. But again, I would just pop in the ChatGPT and drop in the deck and see what it asks. And maybe we'll do that and compare. I want to ask Badlands entropy of execution. How would the sponsor hire and what does that mean? I want to know what it means. I want to get we want a perfect score. I want to do really good. Not just the deck, but I want to know what it means. I know what entropy means. Thank you. The complexity, fragility, and unpredictability in executing the business plan. High entropy execution would be a prop tech startup with hardware, software, regulatory approval. Oh, okay. So we want lower. Lower is good. Okay. Okay. It's stabilized. So good things. It's stabilized. Debt is fixed. Property management is vertically integrated via great residential. Amenity improvement are modest, but this is where we got dinged. Okay. Phasing out legacy leasing concessions. Implementing AI-based revenue management. Exploring corporate and short-term rentals, and integrating property tech systems for net operating NOI growth. So the execution is not simple plug and play, but it's not multi-factor chaos either. Got it. I think it's a little bit more plug and play than they're viewing it as. I see what they're saying. Some of the components are things to try to drive revenue, but the business plan itself doesn't need them. The way we look at a lot of Core Plus deals like Flats and Stones Crossing is that we could just buy it and not do anything at all. But that would just be leaving money on the table because there is more opportunity in the market and at the property. There are some targeted improvements that we could do. You don't want to just throw money at it. That's why we're not investing millions of dollars into CapEx and amenities. We're investing a couple $100,000 to try to improve the AI revenue management. It's a real page product, AIRM or ARM, called it a couple different names. That helps us, spread out our lease expirations a little bit better. It gives prospective residents a little more options on when they want to move in, what price they want to pay, the duration of their lease. It's not that complicated. In the short-term rentals, we're just having so much success at our other properties. I think a lot of these they just don't know the details of it, so it's hard to quantify. And when you can't quantify it, it's a risk, and that is true. So for me, I'm comfortable with all of that. If you're a great capital investor, you've seen the way we do deals. Maybe you are comfortable with that as well. Let me transition over here. Sorry, wasn't showing that. Yeah, so this is why we were scored 5 out of 10. How can we do better? Yeah. Yeah. Okay. Why you don't want high entropy unless you're paid for it. So yeah, high entropy is not good, but it's not automatically bad. It says compensated with higher return potential. Too long, don't read. Entropy of execution. How many moving parts could break or delay execution? Okay, so middle of the road. That's fine. I'm happy with that score. Okay, well, I hope this was useful to you. Check out the Passive Pockets, this Dewey Instant Due Diligence Advisor, or just use ChatGPT or Grok or Gemini, any of those things. I found them to be useful. We have another video where we did it, just using vanilla, I think 3.5 ChatGPT. This was a year or year and a half ago. I don't know, it was a while ago. But it's good stuff. Let us know if you found this video useful. I want to do different types of deal analysis videos, stuff like this, different things. You can subscribe to the Gray Capital YouTube channel to watch episodes of the Gray Report and random videos like this. Thank you.